Hello, and welcome to our comprehensive guide on how to choose the right car insurance for Americans.
Disclaimer. This video is for informational and educational purposes only and should not be considered professional insurance or financial advice. I am not a licensed insurance agent or a financial advisor. To choose the right insurance policy tailored to your individual needs, you should consult with a qualified and licensed insurance professional. Insurance policies, terms, coverage, and premiums vary widely between companies and are subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
My name is Anana. We're going to demystify the world of auto insurance, transforming it from a confusing chore into a straightforward process. Our goal is to empower you with the knowledge you need to make confident, informed decisions that protect you, your family, and your financial well-being. Whether you're a first-time driver, a seasoned car owner looking to switch providers, or simply wanting to understand your current policy better, you've come to the right place. In this first chapter, we will lay the essential groundwork. We'll explore why car insurance isn't just a good idea, but a fundamental requirement of driving in the United States. We will also break down the core concept of insurance and define the basic vocabulary you'll encounter. Think of this as your foundational lesson, the starting line of your journey to becoming an auto insurance expert. Let's begin. First and foremost, let's address the most critical question. Why do you need car insurance? The simplest answer is that it's the law. In nearly every state across America, driving a vehicle without at least a minimum level of insurance is illegal. The only notable exception is New Hampshire, which still requires you to prove you have sufficient funds to pay for damages if you cause an accident. For the rest of us, carrying valid proof of insurance is just as essential as having a driver's license and a registered vehicle. The legal penalties for driving uninsured can be severe and vary by state. They can range from hefty fines, the suspension of your driver's license and vehicle registration, and in some cases, even jail time, especially for repeat offenders. If you are pulled over for a traffic violation or involved in an accident, the first thing a law enforcement officer will ask for, after your license and registration, is your proof of insurance. Not having it can turn a minor incident into a major legal and financial headache. Beyond the legal mandate, car insurance provides a crucial layer of financial protection that no driver should be without. Think about the potential costs of a car accident. Medical bills for injuries, especially if multiple people are involved, can quickly run into the tens or even hundreds of thousands of dollars. Repairing or replacing vehicles is also incredibly expensive. A modern car is filled with complex electronics and safety systems, and even a seemingly minor fender bender can result in a repair bill of several $1,000s. If you are found to be at fault for an accident and you don't have insurance, you are personally responsible for covering all of these costs out of your own pocket. This could mean draining your savings, selling assets, or even having your future wages garnished. A serious accident could lead to a lawsuit that results in a judgment against you, potentially leading to financial ruin. Car insurance is designed to prevent this. It is your shield against the unpredictable and often devastating financial consequences of a car crash. So, how does it actually work? At its core, car insurance is a contract based on a principle called risk transfer. You, the policyholder, face the risk of a potential, uncertain, and large financial loss every time you get behind the wheel. An insurance company is a business that agrees to take on that financial risk for you. In exchange for this protection, you pay the insurance company a regular fee, which is called a premium. This premium is your contribution to a large pool of money collected from thousands or millions of other drivers. When someone in that pool has an accident and files a claim, the insurance company uses the money from the pool to pay for the covered damages. In essence, you are paying a small, predictable amount of money to avoid the possibility of having to pay a huge, unpredictable amount of money later. This contract that details the terms of this agreement, what is covered, how much the company will pay, and what your responsibilities are, is called your policy. To truly understand any subject, you need to know the language. The world of insurance is filled with specific terms that can be confusing at first. Let's take a few minutes to define the most fundamental vocabulary you'll need for the rest of this series. We've already mentioned premium and policy. Let's build on that foundation. The first term is deductible. A deductible is the amount of money you have to pay out of pocket for a covered claim before your insurance company starts to pay. For example, if you have a $500 deductible for collision damage and your car sustains $2,000 worth of damage in a covered accident, you would pay the first $500, and your insurer would pay the remaining $1,500. You typically get to choose your deductible amount when you buy your policy. A higher deductible usually means a lower premium, because you are agreeing to take on a larger portion of the initial risk. Conversely, a lower deductible will result in a higher premium. We will discuss how to choose the right deductible for your budget in a later chapter. Next up is the term claim. A claim is a formal request you make to your insurance company for payment after an incident that is covered by your policy. If another driver hits your car, or your car is stolen, you would file a claim to get compensation for your loss. The insurance company will then investigate the claim to determine its validity and the amount they are obligated to pay based on the terms of your policy. The efficiency and fairness of a company's claim process is one of the most important factors to consider when choosing an insurer. Another crucial term is coverage. Coverage refers to the specific types of protection you purchase as part of your insurance policy. Car insurance isn't a one-size-fits-all product. It's a bundle of different coverages, each designed to protect you against a different type of risk. For instance, one type of coverage might pay for damage to someone else's car if you cause an accident, while another type of coverage would pay for damage to your own car. In the next chapter, we will dive deep into the primary types of coverage, such as liability, collision, and comprehensive, so you can understand what each one does. The limits of your coverage refer to the maximum amount of money the insurance company will pay for a specific type of claim. Finally, let's define the word quote. An insurance quote is an estimate of how much your premium will be for a particular policy with a specific insurance company. It's not a final price, but it's a very close approximation based on the information you provide about yourself, your vehicle, and your driving history. To find the best price for insurance, it is absolutely essential to get quotes from multiple companies. You can get quotes directly from an insurer's website, over the phone, or through an independent insurance agent. Comparing quotes is the single most effective way to ensure you're not overpaying for the protection you need. To recap our first chapter, we've established that car insurance in the United States is a legal necessity and a vital financial safeguard. It operates on the principle of risk transfer, where you pay a predictable premium to protect yourself from potentially catastrophic accident costs. We've also defined the 5 key terms that form the bedrock of any insurance discussion: premium, policy, deductible, claim, coverage, and quote. Mastering this vocabulary is the first and most important step on your path to making a smart insurance decision. Thank you for joining me for this introduction. In our next chapter, we will begin building on this foundation by exploring the different types of auto insurance coverage in detail. We'll break down what they are, who needs them, and how they work together to create a complete safety net for you on the road. I look forward to speaking with you then. Hello and welcome back. In our first chapter, we laid the essential groundwork for understanding car insurance, establishing it as a legal requirement and a critical financial tool. We also defined the basic vocabulary you'll need to navigate your policy. Now that you understand the why and the what, it's time to dive into the heart of an insurance policy, the different types of coverage. Think of an insurance policy not as a single product, but as a customizable package. You choose from a menu of different coverages to build a policy that fits your specific needs. Understanding what each item on that menu does is the most important step in building the right protection. In this chapter, we will break down the 6 most common types of auto insurance coverage, explaining what they protect, who they protect, and why they are important. Let's begin with the absolute cornerstone of every auto insurance policy in America: liability coverage. If a state requires you to have insurance, this is the coverage they're talking about. Liability coverage is not for you. It's for the other people you might injure or the property you might damage if you cause an accident. It protects your assets by paying for the other party's expenses, so you don't have to pay them out of your own pocket and risk a devastating lawsuit. Liability coverage is typically split into 2 parts: bodily injury liability and property damage liability. Bodily injury liability, or BI, covers the costs associated with injuries or death that you cause to another person in an accident. This includes the other driver, their passengers, or even a pedestrian you might hit. It pays for their medical bills, hospital stays, rehabilitation costs, and can also cover their lost wages if they are unable to work. Furthermore, it can pay for legal fees, pain, and suffering if you are sued. Property damage liability, or PD, covers the cost of repairing or replacing property that you damage in an at-fault accident. The most obvious example is the other person's vehicle. But it also covers damage to other types of property, like a fence, a mailbox, a storefront, or a utility pole. When you look at liability coverage on a quote, you'll often see it expressed as 3 numbers separated by slashes. For example, 25/50/25. This is called a split limit. The first number represents the maximum amount, in thousands of dollars, that your insurer will pay for bodily injury to a single person in an accident. In this example, that's $25,000. The second number is the maximum total amount the insurer will pay for bodily injuries for all people in a single accident. Here, that's $50,000. The third number is the maximum amount the insurer will pay for all property damage in one accident, which is $25,000 in this case. It is critically important to understand that state minimum requirements are often very low and may not be enough to cover the costs of a serious accident. We will discuss how to choose the right limits in a future chapter, but for now, just remember that liability coverage is for other people when you are at fault. Now, let's talk about protecting your own car. This is where collision and comprehensive coverage come into play. Together, they are often referred to as physical damage coverage. First, let's look at collision coverage. As the name implies, this coverage pays to repair or replace your own vehicle after it is damaged in a collision with another object. This could be another car, or it could be a stationary object like a tree, a guardrail, or a telephone pole. It also covers damage from your vehicle rolling over. Collision coverage applies regardless of who is at fault for the accident. If you cause the crash, or if you are the victim of a hit and run, your collision coverage can be used to fix your car. This is one of the coverages where your deductible applies. If you have a $1,000 deductible and your car needs $7,000 in repairs, you pay the first $1,000, and your insurance pays the remaining $6,000. The second part of the physical damage duo is comprehensive coverage. This is sometimes called other than collision coverage, which is a perfect description of what it does. It protects your car from damage caused by events that are not a collision. This includes a wide range of incidents, such as theft, vandalism, fire, natural disasters like a flood or a hailstorm, or damage from a falling object. It also covers damage from hitting an animal, which is a very common type of claim in many parts of the country. Just like collision coverage, you will have a deductible for comprehensive claims. While liability coverage is required by law, collision and comprehensive coverages are typically optional if you own your car outright. However, if you have a loan or a lease on your vehicle, your lender will almost certainly require you to carry both to protect their financial investment. Next, we move to coverages designed to pay for your own medical expenses. While your health insurance might cover some costs, auto-specific medical coverages can provide immediate and direct payment for accident-related injuries. The two main types are medical payments coverage and personal injury protection. Medical payments coverage, often called MedPay, helps pay for medical and funeral expenses for you and your passengers if you are injured in an accident, no matter who is at fault. It's designed to cover immediate costs like health insurance deductibles, co-pays, ambulance rides, and doctor visits. MedPay has a set limit, typically a few $1,000s, and is available in most states. Personal injury protection, or PIP, is a more robust form of medical coverage. Like MedPay, it covers medical expenses for you and your passengers regardless of fault. However, PIP goes further. It can also cover lost wages if you are unable to work while you recover, and it can pay for essential services you can no longer perform, such as childcare or housekeeping. PIP is required in what are known as no-fault states and is optional in several others. In no-fault states, your own PIP coverage is your primary source for medical payments after a crash, which is intended to speed up payments and reduce lawsuits. Finally, let's discuss a crucial but often overlooked category of coverage that protects you from other drivers. What happens if you're in an accident that isn't your fault, but the other driver has no insurance at all, or not enough to cover your bills? This is where uninsured and underinsured motorist coverages are essential. Uninsured motorist coverage, or UM, protects you if you are hit by a driver who has no liability insurance. It can pay for your medical bills and, in some states, for the damage to your car. Given that an estimated 1 in 8 drivers in the US is uninsured, this is an incredibly important protection to have. Underinsured motorist coverage, or UIM, applies when you are hit by a driver who has insurance, but their liability limits are too low to cover all of your expenses. For example, let's say your medical bills are $80,000, but the at-fault driver only has a $25,000 bodily injury liability limit. Your underinsured motorist coverage would kick in to help cover the $55,000 shortfall, up to your policy's limits. These two coverages are often sold as a bundle and are mandatory in some states but optional in others. They are a relatively inexpensive way to ensure that you are not left with a mountain of bills because of someone else's irresponsibility. So, let's quickly review. We have liability coverage for damage you cause to others. We have collision and comprehensive coverage for damage to your own car. We have MedPay and PIP for your own medical needs. And we have uninsured and underinsured motorist coverage for when the other driver is unable to pay. These are the primary building blocks you will use to construct your auto insurance policy. Hello and welcome back to our guide on choosing the right car insurance. In the last chapter, we unpacked the different types of coverage that make up a standard auto policy, from the legally required liability coverage to the optional, yet crucial, protections like collision and uninsured motorist coverage. You now know the essential building blocks. Today we take the next logical step. It's not enough to know what these coverages are, you need to decide how much of each you truly need. This chapter is all about moving from theory to practice. We will focus on how to select the right coverage limits and deductibles for your unique financial situation. This is perhaps the most important part of personalizing your policy to ensure you are adequately protected without overpaying. We will also introduce the key factors that insurance companies analyze to determine the final price of your premium. Let's start with the most critical decision you will make: choosing your liability limits. As a reminder, this is the coverage that pays for injuries and property damage you cause to others. Every state has a legal minimum, and it can be tempting to choose that minimum to get the lowest possible price. This is one of the biggest and most dangerous mistakes a driver can make. State minimums are often dangerously low and haven't been updated in years to reflect the modern costs of medical care and vehicle repair. For example, a state's minimum property damage requirement might be just $10,000 or $15,000. The average price of a new car in the United States today is well over $40,000. If you cause an accident that totals an average new car, a minimum limit policy would leave you personally on the hook for a bill of $25,000 or more. One accident could instantly put you deep into debt. So, how much liability coverage do you need? The best rule of thumb is to purchase enough liability insurance to protect your net worth. Your net worth is the total value of your assets, such as savings, investments, and home equity, minus your liabilities, like your mortgage and other debts. If you cause an accident and the costs exceed your insurance limits, the other party can sue you personally. A court can then go after your assets to pay the judgment. Your insurance policy is your first and best line of defense. For most people, a good starting point is to look for a policy with limits of at least $100,000 for bodily injury per person, $300,000 for bodily injury per accident, and $100,000 for property damage. In insurance shorthand, this is often written as 100/300/100. The cost to increase your limits from the state minimum to these much safer levels is often surprisingly small, making it one of the best values in insurance. If you have significant assets, you should also ask about an umbrella policy, which provides an additional layer of liability protection, typically $1 million or more, on top of your auto and homeowners policies. Next, let's talk about the deductibles for your collision and comprehensive coverages. Remember, the deductible is the amount you pay out of pocket before the insurance company pays its share. When you buy your policy, you'll choose your deductible amount, usually from options like $250, $500, $1,000, or even $2,000. There is a direct trade-off here. A higher deductible will result in a lower premium, while a lower deductible will mean a higher premium. The key to choosing the right deductible is to perform an honest assessment of your finances. Ask yourself this simple question: if I get into an accident tomorrow, what is the maximum amount of money I could comfortably pay immediately without causing a major financial problem? That amount is your ideal deductible. It's tempting to choose a high $1,000 deductible to save money on your premium. But if you don't actually have $1,000 available in an emergency fund, that savings won't do you much good when you need to get your car fixed to get to work. Be realistic about what you can afford to pay unexpectedly. Now, let's revisit the decision of whether to carry collision and comprehensive coverage at all. If you have a loan or lease, the decision is made for you. Your lender requires it. But if you own your car outright, it's your choice. The decision should be based purely on the value of your vehicle. A general guideline is to consider dropping these coverages when your car's actual cash value is very low. How low? One method is to drop it when the annual cost of the coverage is more than 10% of your vehicle's value. For example, if your car is worth $3,000 and your collision and comprehensive coverage costs $400 per year, you might consider dropping it. Another way to think about it is this: if the value of your car is less than what your deductible would be plus a year's worth of premiums, it's likely not worth keeping. You can easily check your car's current market value on websites like Kelley Blue Book or Edmunds. For an older car of little value, you might just be paying for coverage that, even if you use it, won't provide a significant payout. Now that you have a framework for choosing your coverages and limits, let's briefly introduce the other side of the equation. What factors do insurance companies use to calculate your premium? The price of insurance is all about risk. An insurer's job is to predict how likely you are to file a claim. The higher your perceived risk, the higher your premium will be. Companies look at a wide range of factors to build a profile of you as a driver. These factors fall into a few main categories. First is your personal information. This includes your age, and in most states, your gender. Statistically, younger, less experienced drivers are involved in more accidents, so they pay significantly higher rates. Your marital status can also have an impact, as married drivers are statistically seen as being more stable and less risky. Perhaps the most significant personal factor is your location. Simply moving to a different zip code, even within the same city, can dramatically change your rates based on local data for traffic, accidents, and vehicle theft. Second is your driving history and experience. This is one of the most direct measures of your risk. A clean driving record, free of accidents and traffic violations like speeding tickets, will result in much lower premiums. Conversely, a recent at-fault accident or a DUI conviction will cause your rates to skyrocket. The number of years you have been licensed to drive also plays a significant role. Third is the vehicle you drive. The make, model, age, and value of your car are all part of the calculation. Sports cars and high-end luxury vehicles are more expensive to repair or replace, so they cost more to insure. Insurers also look at safety data, so a car with excellent crash test ratings and advanced safety features may earn you a discount. Finally, other factors like your credit-based insurance score, in most states, and how much you drive, meaning your annual mileage, are also considered. We will explore each of these factors in much greater detail in the upcoming chapters so you can understand exactly how they affect your wallet. To summarize this chapter, choosing the right insurance is a balancing act. You need to select liability limits that are high enough to protect your life savings, not just meet the legal minimum. You should set a deductible that you can realistically afford to pay at a moment's notice. And you must make an informed decision about optional coverages based on your car's value. Thank you for joining me. In Chapter 4, we will begin our deep dive into the specific rating factors, starting with how your personal demographics, like your age, location, and marital status, influence the price you pay for car insurance. Hello, and welcome back. In our previous chapter, we navigated the critical process of choosing your coverage limits and deductibles, personalizing your policy to shield your financial assets. We ended with a brief introduction to the factors that insurers use to calculate your premium. Today, we begin our deep dive into those factors. You might assume that car insurance rates are based solely on your driving record and the type of car you own. While those are certainly important, they are only part of the story. Insurers are in the business of predicting the future, and to do this, they rely on vast amounts of data and statistical analysis. The first group of factors they examine is your personal demographics. In this chapter, we'll explore how your age, your location, your marital status, and in some cases, your gender, can significantly influence the price you pay for car insurance. Let's start with what is arguably the most impactful demographic factor of all, your age. From an insurer's perspective, age is a powerful proxy for driving experience and risk-taking behavior. The statistics are overwhelming and consistent across the country. The youngest drivers, particularly teenagers between the ages of 16 and 19, face the highest insurance premiums by a wide margin. This isn't a punishment, it's a reflection of risk. National safety data shows that the crash rate per mile driven for this age group is nearly 3 times higher than for drivers aged 20 and over. This is due to a combination of inexperience behind the wheel, a higher statistical likelihood of engaging in risky behaviors like speeding or distracted driving, and simply not having the developed judgment that comes with years of practice. As drivers move into their early 20s, rates begin to decline but remain relatively high. A significant milestone is often reached around age 25. By this point, most drivers have gained several years of valuable experience, and insurers' data shows a sharp drop-off in accident rates. This is when many people see their premiums decrease substantially, assuming they have maintained a clean driving record. The period from age 25 to around age 65 is often considered the sweet spot for insurance rates. Drivers in this broad category are viewed as experienced, mature, and statistically the safest, leading to the most favorable premiums. However, as drivers enter their senior years, typically after age 65 or 70, rates can begin to slowly creep up again. This is due to data that shows a slight increase in accident frequency, which can be attributed to age-related changes in vision, hearing, or reaction time. The good news for older drivers is that many insurers offer special discounts, especially for completing approved defensive driving courses. The next major factor is your geographic location. Where you live, right down to your specific 5-digit zip code, plays a huge role in determining your premium. You could have a perfect driving record and a very safe car, but if you live in an area that insurers consider high risk, you will pay more. There are several reasons for this. First is population density and traffic congestion. A driver in a dense urban center like Brooklyn, New York, is statistically far more likely to be involved in an accident than a driver in a quiet, rural town in Wyoming, simply because there are more vehicles on the road. More cars mean more chances for collisions. Second, insurers look at local crime statistics. Zip codes with higher rates of vehicle theft and vandalism will result in higher premiums for the comprehensive portion of your policy. Third is the frequency of weather-related claims. If you live in a part of the country that is prone to hail, floods, or hurricanes, you can expect to pay more for comprehensive coverage to account for the increased risk of weather damage. Finally, the costs of vehicle repairs and litigation can vary dramatically from one region to another. Areas with higher labor costs for mechanics or a tendency for larger lawsuit settlements will have higher insurance rates to cover those potential expenses. The key takeaway is that your address tells an insurer a lot about the everyday risks your vehicle faces, even when it's just parked on the street. Let's now turn to marital status. It may seem odd, but insurance data consistently shows that married individuals are involved in fewer accidents and file fewer claims than their single counterparts. As a result, married drivers often receive a lower premium. Insurers interpret marriage as a statistical indicator of greater stability and responsibility. The thinking is that married individuals may be more likely to lead a quieter lifestyle, perhaps with children in the car, which encourages safer driving habits. This isn't a personal judgment on anyone's lifestyle. It is a purely data-driven correlation that has proven reliable for insurance companies over many decades of analysis. The last demographic factor we'll discuss is gender, which is also the most controversial. Historically, gender has played a significant role in rate setting, especially for young drivers. The statistical evidence is stark. Teenage boys have a much higher rate of speeding, driving under the influence, and getting into serious, high-impact accidents compared to teenage girls. Because of this elevated risk, a 17-year-old male has traditionally paid a significantly higher premium than a 17-year-old female with an identical car and driving record. This gender gap tends to narrow with age and can even reverse in middle age, with some data showing that women have slightly more minor fender benders while men are involved in fewer but more severe, and therefore more expensive, crashes. However, the use of gender as a rating factor is changing. Recognizing that it can be discriminatory, a growing number of states have banned this practice. States including California, Hawaii, Massachusetts, Michigan, North Carolina, and Pennsylvania no longer allow insurance companies to use gender to calculate premiums. In those states, a male and female driver of the same age and with the same profile will be offered the same rate. In summary, your insurance premium is a complex calculation, and it starts with you. Your age reflects your experience level, your zip code reflects your environment's risks, and your marital status reflects statistical lifestyle patterns. While these are factors you generally cannot change, understanding the role they play is the first step in comprehending your overall insurance costs. Thank you for joining me. In our next chapter, we'll move on to the factors that are much more within your control, your driving history and habits. We'll examine exactly how accidents, tickets, and even the number of miles you drive each year directly affect the price you pay. Hello and welcome back. In our last chapter, we explored the demographic factors like your age and location that create the initial framework for your insurance rates. These are elements that are largely outside of your personal control. Today, we shift our focus to the factors that are directly in your hands. This chapter is all about how your actions, history, and habits behind the wheel shape the price you pay for car insurance. We will cover the 3 key areas that insurers scrutinize to determine what kind of driver you really are: your formal driving record, your overall driving experience, and your daily driving habits. This is where your personal responsibility as a driver is translated directly into dollars and cents. Let's begin with the most influential factor in this category, your driving record. Think of your driving record as your insurance resume. It's a formal history of your behavior on the road, and insurance companies consider it the most accurate predictor of your future risk. A clean record with no accidents or violations tells an insurer that you are a safe, low-risk client. A record with blemishes suggests a higher likelihood of filing a claim in the future. The most significant event that can negatively impact your driving record is an at-fault accident. When you cause an accident that results in an insurance claim, it sends a clear signal to your insurer that you represent a tangible risk. At your next policy renewal, you can expect to see a significant rate increase, which is officially called a surcharge. This surcharge isn't permanent, but it can stay on your policy for a period of 3 to 5 years, depending on the insurer and your state's regulations. The more severe the accident and the larger the claim payout, the greater the surcharge will be. Some insurance companies offer a feature called accident forgiveness as an optional add-on to your policy. This benefit, which you pay a little extra for, prevents your rates from going up after your first at-fault accident. It can be a valuable feature for drivers who have maintained a long history of safe driving. Next on the list are traffic violations, commonly known as tickets. While they may not involve a costly claim like an accident, insurers see them as clear indicators of risky driving behavior. A driver who speeds is statistically more likely to cause an accident than one who obeys the speed limit. Insurers group these violations into 2 main categories. Minor violations include things like speeding up to 15 miles per hour over the limit, running a stop sign, or an improper turn. While considered minor, these can still cause a noticeable increase in your premium that will also last for 3 to 5 years. Major violations are in a different league entirely. These include offenses like driving under the influence of alcohol or drugs, DUI/DWI, reckless driving, street racing, or driving with a suspended license. A conviction for a major violation will have a severe and immediate impact on your insurance. Your rates could easily double or triple, and in many cases, your insurance company may choose to cancel your policy or refuse to renew it, labeling you as too high risk to insure. If this happens, you may be required by the state to file an State Route 22 form, which is a special certificate your insurer files to prove you have at least the minimum required liability coverage. And State Route 22 requirement can make it very difficult and expensive to find insurance for several years. Next, let's distinguish between your age and your driving experience. While they are often related, insurers look at them separately. A key factor is how long you have been a continuously licensed and insured driver. A 40-year-old who just got their license for the first time will pay a much higher rate than a 40-year-old who has been licensed and insured since age 16. A long, uninterrupted history of carrying insurance is seen as a sign of responsibility. This is why a lapse in coverage can be so damaging to your rates. If you let your policy expire and go without insurance, even for just a month or two, you will be seen as a higher-risk customer when you apply for a new policy. Insurers will offer their best rates to those who can demonstrate a stable and continuous insurance history. Finally, let's examine your day-to-day driving habits. Insurance companies want to know how, when, and how much you use your vehicle. One of the primary questions they will ask is for your estimated annual mileage. The logic here is simple. The more time you spend on the road, the greater your exposure to potential accidents. Someone with a long 50-mile round-trip commute to work every day will almost always pay more than someone who is retired and only drives a few thousand miles a year for errands. Related to this is the primary use of the vehicle. Insurers typically classify this in three ways. Pleasure use means you don't use the car for commuting and only for personal trips, which results in the lowest rates. Commute use means you drive the car back and forth to work or school on a regular basis. The third category is business use, which means you use your vehicle as part of your job, such as making sales calls or visiting clients. Business use carries a higher risk and therefore a higher premium. It's especially important to be accurate here. If you use your car for ride-sharing services like Uber or Lyft, or for food delivery, this is considered commercial use and requires a special ride-share or commercial insurance policy. Your personal policy will not cover you while you are working for these services. In recent years, many insurers have started offering a more precise way to measure driving habits through telematics, also known as usage-based insurance. Programs like Progressive Snapshot or State Farm's Drive Safe and Save use a smartphone app or a small device plugged into your car to monitor your actual driving behavior. They track your total mileage, the time of day you drive, and habits like hard braking or rapid acceleration. If you demonstrate safe driving habits, you can earn a significant discount on your premium. This technology allows your rate to be based on your actual risk, not just statistical averages. In summary, the factors we discussed today are a direct reflection of your choices as a driver. Maintaining a clean record free of accidents and tickets is the single most effective way to keep your insurance rates low. Proving your responsibility by maintaining continuous coverage also pays dividends. And by being mindful of your driving habits, you can ensure that your premium accurately reflects your personal risk. Thank you for listening. In Chapter 6, we'll shift our focus from the driver to the machine. We'll explore how the specific make, model, age, and safety features of the car you choose to drive have a major impact on your insurance rates. Hello and welcome back to our comprehensive guide. In the last chapter, we focused on the crucial role your driving record and habits play in determining your insurance premium. We established that your actions behind the wheel are your insurance rate.
Disclaimer. This video is for informational and educational purposes only and should not be considered professional insurance or financial advice. I am not a licensed insurance agent or a financial advisor. To choose the right insurance policy tailored to your individual needs, you should consult with a qualified and licensed insurance professional. Insurance policies, terms, coverage, and premiums vary widely between companies and are subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Resume. Now, we turn our attention from the driver to the vehicle itself. The car you choose to drive is the final major pillar in the complex architecture of your insurance rate. Every vehicle has a unique risk profile, and insurers analyze it meticulously. In this chapter, we'll explore exactly how the make, model, age, safety features, and even the popularity of your car among thieves can have a major impact on your wallet. Let's start with the most straightforward factor, the cost to repair or replace your vehicle. This directly influences the price you pay for your collision and comprehensive coverages, as these are the policies that pay for damage to your own car. The logic is simple. The more expensive and valuable your car is, the more the insurance company stands to lose if you file a claim. A brand new $70,000 luxury SUV will cost vastly more to insure than a 7-year-old $15,000 sedan. If both vehicles are totaled in an accident, the potential payout for the SUV is many times higher, and the premium will reflect that increased risk. Beyond the initial purchase price, certain types of vehicles carry an inherently higher insurance cost. High-performance sports cars and powerful luxury models are a prime example. They are not only expensive to purchase, but their specialized parts and complex systems make them incredibly costly to repair. A minor fender bender in a standard sedan might cost $1,000 to fix, while a similar incident in a high-end sports car could easily result in a $10,000 repair bill. Furthermore, insurers know from decades of data that the type of person who buys a car with a powerful engine is statistically more likely to drive it aggressively, leading to a higher frequency and severity of accidents. This dual risk of high repair costs and riskier driving behavior means these vehicles will always have some of the highest insurance premiums. Even among mainstream vehicles, the cost of parts and labor can vary significantly. Common domestic models, for which parts are plentiful and affordable, are generally cheaper to repair and, therefore, cheaper to insure than some imported or niche models where parts may be scarce and more expensive. Next, let's discuss your vehicle's safety profile. This is a critical factor that primarily impacts the coverages related to injuries, such as your bodily injury liability, medical payments or MedPay, and personal injury protection or PIP. Insurance companies pay close attention to the data provided by independent safety organizations like the Insurance Institute for Highway Safety, IIHS, and the National Highway Traffic Safety Administration, NHTSA. These groups conduct rigorous crash tests on new vehicles and assign safety ratings based on how well the cars protect their occupants in various types of collisions. The insurance logic is clear. A vehicle that earns a Top Safety Pick award from the IIHS is proven to do a better job of preventing or reducing the severity of injuries in a crash. Fewer and less severe injuries mean the insurer will pay out less in medical claims. This reduced financial risk for the insurer is passed on to you in the form of lower premiums for your injury-related coverages. In recent years, the focus has expanded from passive safety, which is how a car protects you during a crash, to active safety, which is technology that helps you avoid a crash altogether. Advanced driver assistance systems, known as ADAS, are becoming increasingly common. Features like automatic emergency braking, which can stop the car if it detects an imminent collision, blind spot monitoring, and lane keeping assist are all statistically proven to reduce the number of accidents. As a result, many insurance companies now offer specific discounts for vehicles equipped with these modern safety technologies. The third major vehicle characteristic that insurers analyze is its risk of theft. This factor directly affects the premium for your comprehensive coverage, as that is the part of your policy that pays out if your car is stolen and not recovered. You might think that flashy, expensive sports cars are the primary targets for thieves, but that's often not the case. Insurance companies use data from organizations like the Highway Loss Data Institute to track theft claims for every make and model of vehicle. This data often shows that the most stolen vehicles are some of the most common and popular sedans and pickup trucks on the road. This is because there is a huge black market for their parts. Thieves can steal a popular car, strip it down, and sell the parts for a significant profit. If you happen to own a model that is a frequent target for thieves, you will pay more for your comprehensive coverage. The good news is that you can offset this risk and earn a discount by having anti-theft devices installed in your vehicle. Insurers typically classify these devices in two ways. Passive devices are those that arm automatically without you having to do anything. The most common example is a modern car key with a computer chip that communicates with the engine's immobilizer. The car simply will not start without the correct key. Active devices are those you have to engage yourself, such as a car alarm you have to turn on, a steering wheel lock, or a GPS-based vehicle recovery system like LoJack. Because they are always working, passive devices usually earn you a better discount. So, what does an insurance-friendly car look like? Generally, it's a moderately priced vehicle, like a sedan, crossover, or minivan, that has excellent safety ratings from the IIHS and NHTSA. It is equipped with modern active safety features and passive anti-theft systems, and it is not on the top 10 list of most stolen vehicles. The most important advice is this: if you are in the market for a new or used car and the cost of insurance is a concern for you, you should get insurance quotes for the specific vehicles you are considering before you sign the paperwork. You might be surprised at how much the premiums can differ between two similarly priced models. To recap, the car you drive is a statement about you, and to an insurer, it's a statement about risk. Its value determines the potential cost of repair, its safety features determine the potential cost of injuries, and its desirability among thieves determines the potential for a theft claim. Thank you for listening. Having now covered demographics, driving habits, and the vehicle itself, we have assembled the core of your insurance rate. In Chapter 7, we'll explore the fun part: how to lower that rate with the wide world of discounts. We'll uncover every possible way to save money, from how you structure your policies to your profession and much more. Hello and welcome back. Over the last 3 chapters, we have constructed the 3 main pillars that support your car insurance premium: your personal demographics, your driving record and habits, and the specific vehicle you drive. Understanding these factors gives you insight into how an insurance company assesses your risk and calculates your base rate. Now, it's time for the most empowering part of our journey, learning how to actively lower that rate. This chapter is dedicated entirely to the world of car insurance discounts. Think of your base premium as the sticker price on a car. It's the starting point, but it's rarely the final price you should pay. By knowing which discounts to ask for, you can significantly reduce your final cost. We'll break them down into logical categories to make them easy to remember. Discounts related to your policy, discounts for you as a driver, and discounts for the features on your car. Let's begin with the first category: policy and loyalty discounts. These are related to how you buy and manage your insurance policies. Often, the single largest discount available to a customer is the multi-policy discount, more commonly known as bundling. Insurance companies love customers who buy more than one product from them. If you purchase your auto insurance from the same company that provides your homeowners, renters, or condo insurance, they will typically reward you with a substantial discount on one or both policies. This discount can range anywhere from 5 to 25%, making it a must-ask question for any homeowner or renter. The company benefits by getting more of your business, and you benefit with significant savings. Similarly, there's the multi-car discount. If your household has more than one vehicle, you'll almost always save money by insuring all of them on the same policy rather than on separate ones. The risk for the insurer doesn't simply double when you add a second car, since you can only drive one vehicle at a time, and this is reflected in a lower combined premium. How you choose to pay your premium can also unlock savings. Insurers prefer to get their money up front and with minimal administrative work. For this reason, most offer a paid-in-full discount. If you can afford to pay your entire 6-month or 1-year premium at once instead of in monthly installments, you can often earn a nice discount. If paying in full isn't feasible, you can still save with an automatic payment discount. By setting up electronic funds transfer, or EFT, from your checking account, you save the insurer the hassle of billing you and reduce the risk of a missed payment, earning you a small price break. In that same vein, a paperless billing discount is often available for customers who agree to receive all their documents and statements electronically, saving the company printing and mailing costs. Finally, be sure to ask about loyalty. Some companies offer discounts for shopping early, getting a quote a week or more before your current policy expires, while others offer increasing discounts for every year you remain a loyal customer with their company. Next, let's move to driver-based discounts. These are designed to reward safe individuals and good habits. The most common and well-known is the good or safe driver discount. If you have maintained a clean record, typically for 3 to 5 years, with no at-fault accidents or moving violations, you will be rewarded with a lower rate. This is the company's way of acknowledging that you are a proven, low-risk client. For families with young drivers, the Good Student Discount is one of the most valuable ways to save money. This discount is for full-time high school or college students, usually under the age of 25, who maintain a certain grade point average, such as a B average or a 3.0. The statistical data shows a strong correlation between academic responsibility and responsible driving, and insurers are happy to reward it. If you have a student on your policy who is attending college far from home, typically over 100 miles away, and they did not take a car with them, you should ask for a distant student discount. Since they will only be driving the family car on holidays and breaks, their risk is dramatically lower, and so is the premium. Another common way to save is by completing an approved defensive driving course. While requirements vary by state and insurer, successfully passing one of these courses can often result in a discount, especially for senior drivers or for drivers looking to reduce the impact of a recent ticket. Lastly, don't forget your connections. Many insurers offer affinity group discounts through partnerships with large employers, alumni associations, professional organizations for fields like teaching or engineering, credit unions, and all branches of the military. Always ask if your job or any group you belong to qualifies you for a special rate. Our final category is vehicle-based discounts, which are tied to the safety and security features of your car. We touched on these when we discussed how your vehicle impacts your rates, but it's crucial to ensure you are actively receiving these price breaks. The anti-theft device discount applies to the comprehensive portion of your policy. You can earn savings for having either passive systems, like a factory-installed engine immobilizer, or active systems, like a visible alarm or a low jack recovery system. You should also receive specific safety features discounts. While things like airbags and anti-lock brakes are now standard, many discounts for them still exist in insurers' rating systems. More importantly, if your car is equipped with modern active safety features like automatic emergency braking, blind spot warning, or lane departure warning, make sure your insurance company knows about it. As these technologies are proven to reduce accidents, the discounts for them are becoming more common and more substantial. Some companies may also offer a small new car discount if your vehicle is less than 3 years old. The most important lesson from this chapter is that you must be a proactive consumer. Never assume that a discount will be applied to your policy automatically. Before you start shopping, make a personal checklist of every single discount we've discussed. When you're getting a quote online or speaking with an agent, go through that list one by one and ask, do I qualify for this? The availability and amount of each discount can vary widely between companies. One insurer may have a slightly higher base rate but offer a massive bundling discount that makes them the cheapest overall option for you. This is a major reason why comparing multiple quotes is so essential. To recap, your final insurance price is a combination of your risk profile and your diligence in finding discounts. By bundling policies, paying smartly, highlighting your safe driving habits and good grades, and cataloging your vehicle's safety features, you can take significant control over your insurance costs. Thank you for listening. Now that you understand the factors, the coverages, and the discounts, it's time to enter the marketplace. In Chapter 8, we will provide a step-by-step guide to the practical process of shopping for, getting, and comparing car insurance quotes to find the absolute best value for your needs. Hello and welcome back. Over the course of this series, we have armed you with a comprehensive understanding of car insurance. You've learned what the different coverages mean, how to decide on the right limits to protect your assets, what factors insurers use to calculate your rates, and how to slash that final price with a long list of discounts. Now, it's time to put all of this knowledge into action. This chapter is a practical, step-by-step guide to the insurance shopping process. We'll walk you through how to prepare, where to shop, and how to accurately compare your options to ensure you find the absolute best policy for your needs at the best possible price. Taking an hour or two to follow these steps each year can save you hundreds, if not thousands, of dollars. Step 1 is preparation. The key to a smooth and efficient quoting process is to have all of your necessary information gathered and organized before you begin. This ensures every quote you get is accurate and saves you from repeatedly searching for the same details. Here is a checklist of what you'll need. First, the personal information for all drivers in your household who will be on the policy. This includes their full names, dates of birth, and their driver's license numbers. Second, you'll need your vehicle information. For each car you're insuring, find the Vehicle Identification Number, or VIN. The VIN is a unique 17-digit code usually found on the driver's side dashboard or door jamb, and it allows insurers to identify your vehicle's exact specifications. Also, note the current odometer reading and make a realistic estimate of the total miles you drive each car per year. Third, be ready with your driving history. Make a list of any accidents or traffic violations for each driver within the past 5 years. Be honest. The insurance companies will pull your official driving records, so it's best to provide accurate information from the start. Finally, if you currently have insurance, find your most recent declarations page. This document summarizes your current coverage limits and is the perfect guide for getting comparable quotes. Step 2 is deciding where to shop. There are 3 primary channels for getting insurance quotes, and the best strategy is often to use a combination of them. The first is buying from a direct insurer. These are companies like Geico and Progressive that market directly to consumers online and over the phone. The process is usually fast and can be done at any time, day or night. The downside is that you have to go to each company's website one by one to get your quotes. The second option is a captive agent. These are agents who work exclusively for one company, such as State Farm, Allstate, or Farmers Insurance. A captive agent will have deep knowledge of their company's specific products and discounts and can often build a strong personal relationship with you. However, they can only offer you quotes from that single company. The third, and often most powerful, option is an independent insurance agent or broker. Unlike captive agents, independent agents work with multiple different insurance companies. Their job is to take your information and shop the market for you, comparing policies and prices from several carriers to find the best fit. They work for you, not for any single insurance company. For the most comprehensive search, a hybrid approach is best. Get quotes from one or two of the major direct insurers yourself, and also contact an independent agent to see what other options they can uncover for you. This ensures you are covering all your bases and seeing a wide swath of the market. Step 3 is the quoting process itself, and here we come to the single most important rule of shopping for insurance. You must compare quotes on an apples-to-apples basis. You cannot accurately compare the price of one policy to another unless you are getting quotes for the exact same coverages, the exact same limits, and the exact same deductibles. Think of it this way. You wouldn't compare the price of a small economy car to the price of a large luxury SUV. In the same way, you can't compare a quote for a bare-bones, state minimum liability policy to one with robust protection and a low deductible. The prices are different because the products are fundamentally different. Using the declarations page from your current policy or the list of desired coverages you created in Chapter 3, enter the identical information into every quote you request. For example, if you want bodily injury liability limits of 100/300, property damage of 100, and a $500 deductible for both collision and comprehensive, you must use those exact figures with every single company. Once you have a collection of quotes for identical policies, you can then see who truly offers the best price. From there, you can ask an agent or use an online tool to see how adjusting your coverage, for instance, raising your deductible to $1,000, would affect the premium with each company. Step 4 is to look beyond the price. The cheapest policy is not always the best one. An insurance policy is a promise to be there for you during one of the worst days of your life, and you want to be sure the company you choose will honor that promise with excellent customer service and fair claims handling. Before you make your final decision, do a little research on the companies that gave you the best quotes. A great place to start is your state's Department of Insurance website. They often publish data on consumer complaints, which can tell you if a company has a higher than average number of unhappy customers. You should also consult independent rating agencies. J.D. Power conducts well-respected annual studies on customer satisfaction with auto insurance claims and shopping experiences. Another key resource is AM Best, which rates the financial strength of insurance companies. Their rating tells you if an insurer has the financial stability to actually pay out on all its claims, even in a major disaster. While online reviews can be helpful, read them with a critical eye, as individual experiences can vary widely. To summarize our action plan, first, prepare by gathering all your driver, vehicle, and policy information. Second, shop through multiple channels, including direct insurers and an independent agent. Third, compare all quotes using identical, apples-to-apples coverage levels. And fourth, investigate the top contenders' customer service and financial reputation before you buy. This methodical process is your path to finding true value. Thank you for listening. Now that you've done the hard work of shopping and have likely chosen a winner, what's next? In Chapter 9, we'll guide you through the final steps of the process: how to officially purchase your new policy, the correct way to cancel your old one to prevent any gaps in coverage, and what to do with your new insurance ID cards and policy documents. Hello and welcome back. In our last chapter, we transformed theory into action, outlining a 4-step strategy for shopping the market and comparing insurance quotes. By now, you've done your research, compared your options, and you have likely selected a new insurance company that offers you the best combination of price and service. You are on the home stretch. This chapter is about crossing the finish line correctly. We will guide you through the final practical steps of finalizing your purchase, managing the transition from your old insurer to your new one, and understanding the essential documents that prove you are covered. Getting these final steps right is critical to ensuring your protection is seamless and uninterrupted. Let's begin with the first step, officially purchasing your new policy. Once you're satisfied with a quote, you'll need to complete a formal application. This can typically be done online, over the phone with an agent, or by signing paperwork in person. Before you submit your payment, it is absolutely crucial that you review every detail on the application. Meticulously check that the vehicle identification numbers, or VINs, are correct for all your cars. Verify the spelling of all drivers' names and their dates of birth. Most importantly, confirm that the coverages, limits, and deductibles listed on the application match the quote you agreed to. This is your last chance to catch any errors before the policy is issued. Your new insurance policy will not become active until you make your first payment. Once your payment is accepted, your policy is in force. At this stage, you will need to choose the effective date. This is the exact date and time that your new coverage officially begins. This decision is critical for a smooth transition. The best practice is to set the effective date of your new policy to be the exact same day that your old policy is scheduled to end. For example, if your current policy expires at 12:01 a.m. on October 1st, your new policy's effective date should be 12:01 a.m. on October 1st. This precision ensures you are never without protection. This brings us to our second and most critical step, the correct way to cancel your old insurance policy. Let me state the golden rule as clearly as possible. You must never, ever cancel your old policy until you have official confirmation that your new policy is active. A lapse in coverage, which is any period, even just a few hours, where you own a registered vehicle but do not have insurance, can have severe consequences. If you drive during that gap, you are driving illegally. If you are involved in an accident, you are personally responsible for all damages, which could lead to financial ruin. Furthermore, a lapse in coverage, no matter how short, automatically labels you as a high-risk driver in the eyes of insurance companies. This will cause your rates to be significantly higher for years to come. Here is the correct and safe procedure for making the switch. First, complete the purchase of your new policy. Wait until you have received confirmation from your new insurer. This confirmation should include your policy number and your official proof of insurance, such as printable ID cards or a digital version in their mobile app. Only once you have this proof in hand should you contact your old insurance company. When you contact your old insurer, you must formally request to cancel your policy. Simply stopping your payments is not the correct way to cancel. If you stop paying without formally canceling, the company can report you to credit bureaus for non-payment, which can damage your credit score. When you speak to them, specify the exact date you want the cancellation to take effect, which, again, should be the same day your new policy begins. If you have paid your premium for the full term, you are entitled to a prorated refund for the unused portion of your policy. Be sure to ask the representative about the refund amount and when you can expect to receive it. Our third and final step today is managing your new insurance documents. As soon as your payment is processed, your new company will provide you with immediate proof of insurance. As we mentioned, this could be a document you can print from their website, a PDF sent to your email, or a digital ID card available in their app. It is your legal responsibility to have this proof with you at all times when you are driving. We strongly recommend printing out a physical copy and placing it in your glove compartment, even if you prefer to use the digital version on your phone. You never want to be in a situation where you can't produce proof of insurance because your phone's battery has died or you're in an area with poor cell service. Within a week or two, you will receive your full new policy packet, either in the mail or electronically. The single most important document in this packet is your new declarations page. This is the one-page summary of your entire policy. When you receive it, review it one last time. Check it against the application you submitted. Ensure every coverage, limit, deductible, driver, vehicle, and discount is listed correctly. If you find any mistakes, contact your agent or the company immediately to have them corrected. The rest of the packet will contain the full policy document, which is the detailed legal contract. You don't need to read it word for word, but you should file it away in a safe place, whether in a filing cabinet or a digital folder, for your records. To summarize this crucial chapter, after choosing an insurer, carefully review the application before you buy. Set your new policy's effective date to match your old policy's end date. Crucially, do not cancel your old policy until your new one is confirmed and active. When you do cancel, do it formally over the phone or in writing. Finally, keep your new ID card in your vehicle at all times and verify the accuracy of your new declarations page. Congratulations! You have now successfully navigated the entire process of shopping for and purchasing car insurance. Thank you for listening. What happens when you actually need to use this policy you've worked so hard to put in place? In Chapter 10, we will demystify the claims process, covering the immediate steps you should take after an accident and how to confidently file a claim. Hello and welcome back. In our journey so far, we have navigated the entire landscape of car insurance, from understanding the complex language of policies to the practical steps of purchasing the right coverage for you. You are now fully equipped with a policy designed to protect you. But all of this preparation is for a moment you hope never comes, the moment you actually need to use it. An auto accident, even a minor one, can be a disorienting and stressful experience. Knowing exactly what to do in the minutes, hours, and days that follow can make a tremendous difference. This chapter is designed to be your calm and clear guide through that process. We will demystify the claims process, turning your policy from a piece of paper into tangible protection. We'll divide our discussion into two parts. First, the immediate steps to take at the scene of an accident, and second, how to officially file your claim. Let's begin with the first and most critical phase, your actions at the scene. The number one priority in any accident is the health and safety of everyone involved. The first thing you must do is check for injuries. Assess yourself and your passengers. Then, if you are able, check on the occupants of the other vehicle or anyone else involved. If anyone is hurt, your first and only action should be to call 911 immediately. Report the injuries and the location of the accident. Unless a person is in immediate danger from a fire or other hazard, do not attempt to move someone who is seriously injured. Wait for emergency medical personnel to arrive. If the accident is minor and there are no apparent injuries, try to move the vehicles out of the flow of traffic to a safe location, like the shoulder of the road. Once you are out of harm's way, turn on your vehicle's hazard lights to alert other drivers. Your next step is to contact the police. For any accident that involves more than a trivial scratch, it is always a good idea to call the police. An official police report is an objective, third-party record of the incident. The officer will document the scene, gather statements, and often make an initial determination of fault. This report becomes an invaluable piece of evidence for your insurance company.
Disclaimer. This video is for informational and educational purposes only and should not be considered professional insurance or financial advice. I am not a licensed insurance agent or a financial advisor. To choose the right insurance policy tailored to your individual needs, you should consult with a qualified and licensed insurance professional. Insurance policies, terms, coverage, and premiums vary widely between companies and are subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Preventing the situation from devolving into a he said, she said dispute later on. Once safety has been addressed and the police have been called, you need to exchange information with the other driver or drivers. It is essential to be calm, polite, and cooperative during this exchange, but it is equally essential that you do not admit fault. Even a simple apology like, "I'm so sorry, I didn't see you," can be interpreted as an admission of guilt and can be used against you during the claims process. Stick to the facts. You need to collect the following information from the other driver: their full name, address, and phone number, the name of their insurance company and their policy number, and the make, model, color, and license plate number of their vehicle. If there are any witnesses to the accident, ask for their names and contact information as well. Their statement could be crucial if the other driver's story changes later. While you are waiting for the police, you should become a documentarian. Use your smartphone to capture as much evidence as possible. Take wide shots of the entire accident scene from multiple angles, showing the positions of the cars. Take close-up photos of the damage to all vehicles involved. Be sure to photograph the other vehicle's license plate. It's also wise to take pictures of anything in the surrounding area that might be relevant, such as skid marks on the road, traffic signals or signs, and any road or weather conditions that may have been a factor. If the other driver agrees, taking a clear photo of their driver's license and insurance card is an easy way to ensure you've recorded the information accurately. Now we move to the second phase, filing the claim with an insurance company. You should report the accident to your insurer as soon as you are able, while the details are still fresh in your mind. Most companies have 24/7 claims hotlines and streamlined processes for filing a claim through their mobile app or website. But whose insurance company should you call? If the accident was clearly your fault, you'll report the claim to your own insurer. They will handle the other party's damages through your liability coverage and your own vehicle's damages through your collision coverage, if you have it. If the accident was clearly the other driver's fault, you generally have two options. The first is to file what's called a third-party claim directly with the at-fault driver's insurance company. The second option is to file the claim with your own insurance company under your collision coverage. The advantage of going through your own insurer is that they will typically handle your repairs much faster, and your customer service experience will likely be better. You will have to pay your deductible up front, but your insurer will then work to recover that deductible and their own costs from the other driver's company, a process called subrogation. Filing directly with the other company means you won't have to pay a deductible, but the process can sometimes be slower and more adversarial. When you make that first call to the insurance company, you are initiating what is known as the first notice of loss. You will provide the agent with all the information you gathered at the scene. The company will then assign you a unique claim number and a dedicated claims adjuster. The adjuster is the person who will manage your case. Their job is to investigate the accident by reviewing the police report, your photos, and any witness statements. They will also assess the damage to your vehicle. This may involve sending an appraiser to look at your car in person, or they may ask you to submit photos and videos through their app. The adjuster will then evaluate the cost of repairs and authorize payment to the body shop of your choice. If the repair costs exceed a certain percentage of the vehicle's value, the adjuster may declare the car a total loss. Throughout this process, your adjuster should be your main point of contact, providing you with updates and answering your questions. To summarize, being in an accident is tough, but having a plan makes it manageable. At the scene, prioritize safety, call the police, exchange information without admitting fault, and document everything. When filing your claim, do it promptly, know your options, and cooperate with the claims adjuster assigned to your case. Thank you for listening. The claim is now filed, but what comes next? In Chapter 11, we will explore the aftermath of a claim, discussing how it can affect your future insurance rates, what it means for your car to be declared a total loss, and what steps you can take if you have a dispute with your insurance company's decision. Hello and welcome back. In our last chapter, we provided a clear roadmap to follow in the chaotic moments after an accident, guiding you through the process of filing a claim. That initial action sets a complex series of events into motion. This chapter is about navigating what comes next, the aftermath. Once the claim is filed, new questions and concerns often arise. Will this accident cause my rates to skyrocket? What does it mean if the insurance company says my car is a total loss? And what can I do if I disagree with the adjuster's decision? We will explore the answers to these critical questions to ensure you can manage the post-claim process with confidence and achieve a fair outcome. Let's start with the question that is on every driver's mind after an accident. Will my insurance rates go up? The answer, quite simply, is that it depends on the circumstances of the claim. The most important factor is who was at fault. If you are found to be at fault for the accident, it is very likely that your premium will increase at your next policy renewal. This rate increase or surcharge is a direct result of your risk profile changing. You have gone from being a driver who might have an accident to one who actually has. The size of the increase will depend on the severity of the claim, and the surcharge will typically remain on your policy for 3 to 5 years. Of course, if you have purchased an accident forgiveness endorsement on your policy, your first at-fault accident should not result in a rate increase. On the other hand, if the accident was clearly not your fault, for example, you were rear-ended while stopped at a red light, most states have laws that prohibit your insurance company from raising your rates. A not-at-fault accident does not indicate that you are a risky driver. However, it's worth noting that in some states, having multiple not-at-fault accidents in a short period could cause you to lose a claims-free discount, which would feel like a rate increase. Finally, there are comprehensive claims, for things like a cracked windshield, hail damage, or hitting a deer. Generally, a single, isolated comprehensive claim will not impact your premium. These events are seen as being outside of your control. But, if you file several comprehensive claims within a few years, an insurer might see a pattern of high risk associated with where you live or park your car, which could lead to a higher premium for that specific coverage. Next, let's demystify one of the most misunderstood outcomes of a claim: having your vehicle declared a total loss. This does not necessarily mean your car is a crumpled, unrecognizable wreck. A vehicle is declared a total loss when the cost to repair it safely and correctly is more than the vehicle's value. That value is not what you paid for the car, or what a new one would cost, but its actual cash value, or ACV. The actual cash value is what your specific car, with its exact year, make, model, mileage, and condition, was worth in the marketplace the moment before the crash occurred. Insurance companies determine the ACV by analyzing sales data for very similar vehicles that have recently sold in your local area. If your car is declared a total loss, the insurance company will make you a settlement offer equal to its calculated ACV, plus any applicable taxes and fees. It is important to know that you do not have to accept the company's first offer. If you believe their valuation is too low, you have the right to negotiate. You can do your own research on websites like Kelley Blue Book, Edmunds, or by looking at local dealership and private seller listings for cars that are a direct match to yours. If you can present the adjuster with several examples of your car selling for a higher price, you can often negotiate a more favorable settlement. If you decide to keep the totaled car to repair yourself or sell for parts, the insurer will pay you the ACV minus the vehicle's salvage value, the amount they would have gotten for it from a scrapyard. This brings us to our final topic: what to do when you have a dispute with your insurance company. While most claims are handled smoothly, disagreements can arise. You might disagree with the determination of fault, the estimate for repairs, or the actual cash value offered for your totaled vehicle. If you find yourself in this situation, there is a clear, escalating process you can follow. Your first step is always to communicate clearly and professionally with your assigned claims adjuster. Lay out your side of the issue and, most importantly, provide any and all evidence you have to support your position. This could be witness information, photos from the scene, or the comparable vehicle listings we just discussed. Often, a simple, evidence-based conversation can clear up a misunderstanding. If you and your adjuster reach an impasse, your next step is to politely ask to speak with their manager or a claims supervisor. A different person with a fresh perspective may be able to reevaluate the claim and find a path to a resolution. If that still doesn't work, your policy itself contains a powerful tool called the appraisal clause. This clause can be invoked for disputes over the value of a claim. It allows both you and the insurance company to hire your own independent appraisers. Those two appraisers then agree on a neutral third appraiser, called an umpire. A settlement amount that is agreed upon by any two of those three parties becomes legally binding. This is a more formal process, but it is an effective way to get an objective resolution. Finally, if you feel the insurance company is not honoring the terms of your contract or is acting in bad faith, you can file a complaint with your state's Department of Insurance. This government body regulates the industry and will investigate your complaint on your behalf. To summarize, the aftermath of a claim has its own set of rules. An at-fault claim will likely affect your rates, while a total loss settlement is based on a negotiable actual cash value. And if disputes arise, you have a clear pathway, from talking with your adjuster to involving a neutral appraiser, to ensure you are treated fairly. Thank you for listening. So far, we've focused on the standard coverages in an auto policy. But what if you need more? In Chapter 12, we'll explore the most popular optional coverages and endorsements you can add to your policy, such as rental car reimbursement, roadside assistance, and gap insurance. Hello and welcome back. Throughout this series, we have systematically built a complete picture of a standard American car insurance policy. You understand the core coverages like liability and collision, you know how your rate is calculated, and you're prepared to handle the claims process. Now, we're going to move beyond the standard package and explore the world of optional coverages and endorsements. Think of your main policy as the foundation of a house. These endorsements are the custom features you can add to make it perfectly suit your lifestyle and needs. For a relatively small cost, these add-ons can provide immense convenience, peace of mind, and critical financial protection in specific situations. Today, we'll cover the most popular and valuable options you can add to your policy. Let's begin with one of the most useful convenience coverages, rental reimbursement. Imagine you're in an accident, and while you're not injured, your car needs to be in the repair shop for 2 weeks. How will you get to work, take your kids to school, or run essential errands? If you don't have access to a spare vehicle, you'll have to pay for a rental car out of your own pocket, which can quickly become expensive. Rental reimbursement coverage is designed to solve this problem. If you have this endorsement, your insurance company will help pay for the cost of a rental car while your vehicle is being repaired due to a covered collision or comprehensive claim. This coverage isn't unlimited. It comes with a per day and a total maximum limit. A typical plan might be expressed as $30 a day, up to a $900 maximum. This means your insurer would pay up to $30 per day for your rental, for a maximum of 30 days. You can usually choose higher limits, like $50 or $75 a day, for a slightly higher premium. It's important to remember this coverage only applies for a covered claim, not for when your car is in the shop for routine maintenance or mechanical issues. Next up is another popular convenience coverage, roadside assistance, sometimes called towing and labor. This endorsement is your safety net for those frustrating moments when your car is disabled on the side of the road. Instead of having to search for a local tow truck and pay their emergency rates, this coverage gives you a single, 24/7 number to call for help. The services typically included are towing to the nearest qualified repair shop, a battery jumpstart, a flat tire change, fuel delivery if you run out of gas, and lockout services if you accidentally lock your keys in the car. This coverage is usually very inexpensive to add to your policy and can be a great alternative for those who don't have a separate membership with an auto club like AAA. Now, let's discuss an optional coverage that moves beyond convenience into the realm of crucial financial protection, gap insurance. The gap in gap insurance stands for Guaranteed Asset Protection, and it is designed to protect you from a very common financial trap with new cars. When you buy a new car, it begins to depreciate or lose value the moment you drive it off the lot. For the first few years of your loan, it is very likely that you will owe more on your car loan than the car's actual cash value. This situation is called being upside down or having negative equity. Now, imagine your new car is stolen or totaled in an accident. Your insurance company will pay you the car's actual cash value. But if that amount is less than what you still owe the bank, you are legally responsible for paying off the difference, the gap, for a car you can no longer drive. This is where gap insurance steps in. It pays off that remaining loan balance after your comprehensive or collision insurance has paid the ACV. Who needs this? Gap insurance is essential if you made a small down payment of less than 20%, if you financed your vehicle for a long term like 60 months or more, or if you rolled negative equity from a previous trade-in into your new loan. It is also almost always a requirement if you are leasing a vehicle. A critical tip: it is almost always significantly cheaper to buy gap insurance as an add-on from your auto insurer than it is to buy it from the car dealership's finance office. Beyond these three main options, there are a few other valuable endorsements to consider. For those who buy a brand new car replacement coverage is a step above gap insurance. If your new car is totaled within the first year or two of ownership, instead of just paying the depreciated ACV, this coverage pays for a brand new vehicle of the same make and model. If you are someone who likes to personalize your ride, you should look into custom parts and equipment coverage, or CPE. Your standard policy will only cover the value of factory-installed parts. If you've spent money on expensive custom wheels, an upgraded sound system, a new paint job, or performance modifications, you need CPE coverage to ensure those investments are protected in case of an accident or theft. Finally, as we've mentioned before, if you drive for a rideshare service like Uber or Lyft, you need special rideshare coverage. Your personal policy does not cover you during the time you are logged into the app and waiting for a ride request. This inexpensive endorsement fills that specific gap in coverage, protecting you until the rideshare company's much more robust insurance kicks in after you've accepted a ride. In summary, your insurance policy doesn't have to be one size fits all. Endorsements like rental reimbursement and roadside assistance add valuable convenience, while options like gap insurance provide a critical financial safety net. By understanding these add-ons, you can truly customize your policy to match your exact needs. Thank you for listening. We have now covered the personal auto policy in extensive detail. But insurance needs are not static. They change as your life changes. In Chapter 13, we will discuss how major life events, like getting married, moving, buying a home, or adding a teenage driver, impact your insurance, and what you need to do to stay properly covered through it all. Hello and welcome back. In our last chapter, we explored the world of optional endorsements, learning how you can customize your policy with features like rental reimbursement and gap insurance to perfectly match your needs. By now, you have a deep understanding of how to build, buy, and use a personal auto insurance policy. However, a common mistake is to treat that policy as a static, set it and forget it product. The reality is that your insurance needs are not frozen in time. They are dynamic and will evolve as you navigate the major milestones of your life. This chapter is your guide to managing your policy through those changes. We'll discuss how events like getting married, moving, buying a home, or adding a new driver to your family impact your insurance, and the crucial steps you need to take to ensure you remain properly protected and are always getting the best possible rate. Let's begin with a happy occasion, getting married. Once you are married, you and your spouse should combine your car insurance policies. This is beneficial for a couple of key reasons. First, as we learned in our chapter on rating factors, married individuals are statistically seen as lower risk drivers, and insurers reward this with a marriage discount, which can lead to immediate savings. Second, by putting both of your vehicles on a single policy, you will qualify for a significant multi-car discount. You should contact your insurance company shortly after your wedding to inform them of your change in marital status and begin the process of merging your policies. It's a great opportunity to review your combined coverage and make sure it's adequate for your new family's needs. Our next life event is moving. Your physical address is one of the most powerful factors in determining your premium, so any change of residence will affect your rate. If you are moving within the same state, even just to a different zip code across town, your premium will be adjusted to reflect the risks of your new neighborhood, such as different traffic patterns or crime rates. You must notify your insurer of your new address to ensure your coverage remains valid. If you are moving to a new state, the change is more significant. Your new state will have its own laws regarding minimum liability requirements and may require specific coverages, like personal injury protection in no-fault states. Your current insurance company may not even be licensed to operate in your new state. A move to a new state is the perfect trigger to completely reshop your insurance to find the best coverage and price in your new market. Another major financial milestone is buying a home. This is one of the best opportunities to save a substantial amount of money on your insurance. As we discussed in the chapter on discounts, the multi-policy or bundling discount is often the single largest price break an insurer offers. When you are purchasing your new homeowner's insurance policy, you should get a quote from the same company that carries your auto insurance. By bundling the two policies together, you can unlock savings that often range from 10 to 25% on both your home and auto premiums. If you are currently bundling with a renter's policy, be sure to check with your agent when you buy a home, as the discount for a home and auto bundle is often even larger. Perhaps the single most dramatic life event, in insurance terms, is adding a teenage driver to your policy. As a parent, you can expect your premium to increase significantly, often doubling or more. This is a direct reflection of the statistical risk, as teen drivers have the highest accident rates of any age group. The key here is to be proactive to mitigate the cost. First, notify your insurer when your teen gets their learner's permit. Then, as a licensed driver, ensure you are pursuing every available discount. The good student discount is essential. See if the insurer offers a discount for completing a driver's education course. It is also a critical time to reshop your insurance. Some companies are much more competitive than others when it comes to insuring families with young drivers. Most importantly, this is a time to review and likely increase your liability coverage limits to protect your family's assets against the heightened risk. Finally, let's consider changes to your daily routine and driving habits. If you get a new job, your commute may get longer or shorter. If your annual mileage changes significantly, you should let your insurer know, as it could affect your rate. An even bigger change occurs if you begin working from home or you retire. If you are no longer commuting to work each day, your risk of an accident drops dramatically. You should call your insurer and ask them to reclassify your vehicle's primary use from commute to pleasure. This simple phone call can result in a meaningful reduction in your premium. And of course, anytime you buy a new or different car, you are introducing a major change to your policy. Always remember to get insurance quotes for the specific vehicles you're considering before you buy, so you can see how your choice will impact your budget. In summary, your car insurance policy should be a living document that accurately reflects your current life situation. By proactively communicating with your insurance company during these major milestones, you not only ensure that your coverage remains appropriate and valid, but you also empower yourself to find every opportunity for savings along the way. It's a good practice to schedule a brief review of your policy with your agent at least once a year, just to make sure everything is up to date. Thank you for listening. We've now covered personal auto insurance from nearly every angle. But what happens if you use a vehicle primarily for business? In our next chapter, we will explore the distinct world of commercial auto insurance, explaining who needs it, how it differs from a personal policy, and what it covers. Hello and welcome back. For the entirety of this series, our focus has been squarely on the world of personal auto insurance, the policies that protect you and your family as you go about your daily lives. But what happens when your driving crosses the line from personal errands into professional work? The moment you begin using a vehicle as a tool for your business, you enter a different insurance landscape. In this chapter, we will explore the distinct world of commercial auto insurance. We'll explain who needs it, how it fundamentally differs from a personal policy, and the significant risks you take by not having the proper coverage. This is essential listening for any small business owner, independent contractor, gig worker, or anyone who uses their vehicle to earn an income. The first and most important question is, who actually needs a commercial auto policy? The line between personal and business use can sometimes feel blurry, but the consequences of getting it wrong can be severe. Let's start with the clear-cut cases. You absolutely need a commercial auto policy if the vehicle is owned by a business, such as a corporation, partnership, or LLC. You also need it if you transport goods or people for a fee, which includes delivery services, taxi or limousine work, and trucking. If you work in a skilled trade, like plumbing, electrical work, or construction, and you use a van or truck to carry tools and supplies to job sites, you need commercial coverage. Essentially, if your vehicle is a core part of your business operations, a personal policy is not sufficient. The gray area is where many people get confused. What about a real estate agent who drives clients to see properties? Or a gig worker delivering food for a service like DoorDash or Grubhub? What about a home-based business owner who makes occasional bank deposits or post office runs? In most of these scenarios, a standard personal policy is not enough. The extensive driving for client meetings or the act of delivering goods for a fee falls outside the scope of personal use. While we previously discussed a rideshare endorsement for services like Uber, that endorsement specifically does not cover food or package delivery. The only use case that is definitively covered by a personal policy is your daily commute to and from a single primary place of work. If your driving for work is more complex than that, you must assume you need more than a personal policy. So, how is a commercial policy different? There are three fundamental distinctions. The first is liability protection. Commercial auto policies offer significantly higher liability limits. While a robust personal policy might have limits of a few $100,000, commercial policies typically start at $1 million in liability coverage and can go much higher. This is because a business generally has more assets at risk in a lawsuit than an individual. An accident involving a vehicle with a company logo on the side is often seen by attorneys as an opportunity to sue a business with deep pockets, so higher limits are essential for protection. The second difference is the breadth of coverage. Commercial policies include specialized options that personal policies simply do not offer. A critical example is hired and non-owned auto coverage. This protects your business when you or an employee are driving a vehicle you don't own for business purposes. For example, if you send an employee to run an errand in their own personal car and they cause an accident, non-owned auto coverage can protect your business from being sued. Commercial policies also offer coverage for permanently installed equipment, like tool racks or ladder hooks, and can include cargo coverage to protect the value of the goods or materials you are transporting. The third distinction is who is covered to drive. A personal policy is designed to cover the policyholder and their resident family members. A commercial policy is more flexible, designed to cover the business owner and any employees who have permission to operate the company vehicle. This provides much broader protection for a business that has multiple people driving. Now we come to the most important takeaway of this chapter, the high cost of being wrong. Nearly every personal auto insurance policy in America contains a business use exclusion, or commercial use exclusion, clause. This clause is a critical piece of the legal contract. It explicitly states that the insurance company will not provide coverage for accidents that occur while the vehicle is being used for business or commercial purposes that are not disclosed and approved. Let's be perfectly clear about what this means. If you are using your vehicle for a business activity and you get into an accident, your personal insurance company has the legal right to deny your claim entirely. Imagine you are a freelance photographer driving home from a paid event and you cause a multi-car accident. When the insurer investigates, they discover you were engaged in business use. They could invoke the exclusion clause, leaving you personally and financially responsible for all the injuries and property damage you caused. It is a gamble that could lead to financial ruin, and it is a risk you should never take. In summary, the line is simple. If you use your car for work, you need insurance that is designed for work. Commercial auto insurance provides the higher liability limits and specialized coverages that businesses require. Attempting to rely on your personal policy for business use is a massive financial risk due to the business use exclusion clause found in almost every personal policy. If you have any doubt whatsoever about your situation, the only safe course of action is to call your insurance agent, have an honest and detailed conversation about exactly how you use your vehicle, and get the proper coverage in place. Thank you for listening. We have now covered the spectrum of both personal and commercial auto insurance. In our final chapter, we will turn our eyes to the horizon and look at the future of this industry. We'll discuss the emerging trends like telematics and pay-per-mile insurance, and speculate on how the dawn of self-driving cars may change everything. Hello, and welcome back for the 15th and final chapter of our comprehensive guide to choosing the right car insurance. For the past 14 chapters, we have journeyed together through every facet of this complex topic. We started with the basic vocabulary and the fundamental reasons for having insurance. We dissected the different types of coverage, learned how to select the right limits, and uncovered how your demographics, driving habits, and vehicle choice all come together to create your premium. We've built an action plan for shopping the market, navigating the claims process, and adapting your policy to major life events. We even explored the separate world of commercial auto insurance. You are now equipped with the knowledge to be a confident, empowered insurance consumer. In this final chapter, we will turn our eyes from the present to the future. The auto insurance industry, which has operated on the same basic principles for a century, is on the cusp of a radical transformation, driven by technology and changing social habits. We'll explore the emerging trends that are already reshaping how insurance is priced and sold, and we'll look further down the road to the single biggest disruption on the horizon, the rise of the self-driving car. The first and most immediate trend is the rapid growth of telematics, also known as usage-based insurance or UBI. We introduced this concept in our chapter on discounts, but its impact is much more profound. Usage-based insurance shifts the focus from pricing based on statistical averages, like your age and zip code, to pricing based on your actual, individual driving behavior. Using a smartphone app or a small device that plugs into your car, these programs monitor how you drive. They measure factors like your total mileage, the time of day you drive, and the frequency of risky events like hard braking, rapid acceleration, and cornering too quickly. Some advanced apps can even detect phone use while the car is in motion. The benefit of this technology is the ultimate form of personalization. If you are a genuinely safe and cautious driver, you can prove it with data and be rewarded with a significant discount, sometimes as high as 30 or 40%. It allows you to separate yourself from the statistical risk of your peer group. Of course, this raises valid concerns about privacy for some drivers. However, insurers are generally focused on analyzing broad patterns of risk, not tracking your specific destinations. And for millions of drivers, the potential savings are worth the trade-off. A specific and popular form of telematics is pay-per-mile insurance. This model is built for a growing part of the population that doesn't drive very much. If you are a retiree, you work from home, or you live in a city and primarily use public transportation, a traditional insurance policy might feel unfair, as you're paying for risk based on an assumption of average mileage. Pay-per-mile insurance fixes this. With these policies, you pay a low flat base rate each month, and then a very small additional fee, typically just a few cents, for each mile you actually drive. If you have a month where you barely use your car, your bill will be very low. It is the most direct and fair way to align your insurance cost with your actual usage. These trends are already here, but the truly game-changing shift is still on the horizon: the arrival of fully autonomous, or self-driving, vehicles. The widespread adoption of this technology will challenge the very foundation of the insurance principles we've discussed in this series. For the last 100 years, auto insurance has been based on a simple premise: human error. Over 90% of all accidents are caused by a mistake made by a human driver. But what happens when the human is no longer driving? The core question becomes, if a fully autonomous car causes an accident, who is at fault? Is it the person in the driver's seat who was merely a passenger? Is it the car company that manufactured the vehicle? Or is it the tech company that designed the artificial intelligence and software that was in control? The consensus is that we will see a massive shift from the concept of personal liability to product liability. The responsibility for an accident will move from the individual driver to the corporation that built the autonomous system. This could mean that in the future, you won't buy your own personal auto insurance policy. Instead, the manufacturer, like Tesla, Waymo, or General Motors, will purchase a massive liability policy to cover their entire fleet of vehicles, and the cost will be bundled into the price of the car or into a monthly software subscription. The ultimate promise of self-driving cars is a future with dramatically fewer accidents, injuries, and fatalities. A world with far less risk would be a world with far lower insurance costs. The transition, however, will be complex. For the next several decades, our roads will be a mixed environment of human drivers, semi-autonomous cars, and fully autonomous cars all interacting with one another, creating new and unpredictable risks for insurers to navigate. To conclude our series, let's bring it all back to a central truth. Whether you're dealing with the insurance system of today or the technology of tomorrow, the fundamental purpose of insurance remains the same. It is a tool to manage risk and protect your financial well-being. The technology and the policies will undoubtedly change, but the principles of being an informed and proactive consumer will always be your most valuable assets. Understanding your needs, knowing your options, shopping the market intelligently, and keeping your policy up to date with your life are the timeless skills that will serve you well, no matter what the future of driving holds. Thank you for joining me on this journey through the world of American car insurance. I hope you now feel confident and prepared to make the best decisions for your safety and your family. Drive safely.
Disclaimer. This video is for informational and educational purposes only and should not be considered professional insurance or financial advice. I am not a licensed insurance agent or a financial advisor. To choose the right insurance policy tailored to your individual needs, you should consult with a qualified and licensed insurance professional. Insurance policies, terms, coverage, and premiums vary widely between companies and are subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.